I'm Louise Farrand, editor of Engaged Investor magazine. Welcome to our roundtable on absolute returns.
And the way that I'd characterise the absolute return sector is that at the end of the day, we're all trying to achieve the same objective, which is an upwards only target, generally to beat cash, to beat inflation, but also very much to preserve capital on the downside. And I think the approach that various managers use to achieve absolute return is very wide-ranging. And obviously what we're trying to do is really focus the returns on expectations on the liabilities of the underlying investors of the pension scheme.
I very much agree with Susan. I would very simply characterize absolute return by protecting our clients' money in every single market environment.
Peter, I know that you use absolute return funds at the Pensions Trust, right? How straightforward did you find it choosing one?
Not as straightforward as it used to be, I think. Because as these sectors sort of developed, I think you started off probably with a couple of fund managers. It was like an old balanced mandate, relatively simple, long only, equities, bonds and cash. And it sort of evolved over time to replicate sort of mini hedge fund strategy, I think. So the sector's much broader than it used to be. So I think it's probably more difficult for trustees to go out and say, I want an absolute return fund, pick two managers and actually get the same thing. So it's more challenging than it used to be.
Steve, what do you think trustees should be expecting from such a strategy? And when you're advising them, what sort of things do you say when you ask about, when they'll say what's its performance characteristics, for example?
In terms of expectation, I think it comes back to having, you need to understand what it is that you're trying to achieve first and foremost. So I agree with Giles. And once then that is in place, then you have the mandate to then compare the strategy to. So if it is that you're putting the fund in to protect against the downside, then clearly that is your focus. But if you want something which is going to maintain growth alongside an equity portfolio, over the very long term, then again you've got a different kind of objective around that strategy. So it very much depends on why it's there in the first place to why, how you can maintain it's good or not.
I think there's a lot of capital protection and to not have any of your losses compounded, because that can really set a portfolio significantly back. I think the real problem for trustees is actually understanding exactly what's going on, because I made a bit of a note of some of the names of these funds, and GARS, Diversified Target Return Fund, Broad Opportunities Fund, Dynamic Diversified Growth. And you put these in front of the trustees and you say, well, they're roughly doing the same thing, but they've got such a different name and it doesn't do what it says on the tin.
What do you think some of the sort of killer questions are that trustees ought to be asking? Maybe that's a question for Steve. What are the sort of difficult, challenging questions that schemes ought to be asking about absolute returns?
When we talk to support our schemes and trying to understand these funds, if they are meeting with a manager, then it's good context to give them performance versus their peers, because it might be that equity markets have done very well, and therefore, the multi-asset fund in an absolute return kind of format hasn't done as well, but you're not expecting it to have, kept pace with equity markets. But if you compare it to other funds in the on a buy list or, out in the market, then it gives you context. It might be the furthest forward compared to its peers. So it's trying to look at what we're trying to say is maybe look at the shape of returns over the last period of time, against the objectives that it's been set, and then you can support with the key questions around how that return's been produced, how the portfolio has changed over that period, and the typical questions you'd ask for multi-asset funds.
Can I just come in on that point? It's one of the challenges here is that you can see how a strategy will work up to a size, say 5 billion. One of the questions that's well worth asking is, so if you can develop the strategy up to 5 billion, can you take it to 7, 10? As for example, you mentioned GARS. One of the questions that they've had to answer consistently is, how much bigger can you get and continue to deliver those sorts of returns. And the other question is, this is very much, since we have fund managers present, it's very much a people activity as well. And it's noticeable how some of those key funds have lost key people in recent times, moving to other fund managers as startups.
I mean, how do fund managers seek to kind of mitigate those personnel changes, and to what extent is the core team really important to an absolute return fund?
Maybe I should start answering this
Sure.
question while Suzanne sat there. I think the points that are raised are absolutely valid, and I think from a trustee's perspective, it's looking at the resources of the team. There's clearly going to be individuals within that team, but it's really taking a view in terms of the support and the input from, particularly within the fund team that they're talking about. We're looking at the broader resources of the firm, and looking not so much at how many people are on the page on the marketing booklet, which I'm sure you've all seen, but really understanding what is the input from the analysts, what is the input from the strategy team, what is the input from the external funds. Because each firm will be different, each fund will certainly be different, but I think you can, by a little bit of probing in terms of how they manage fund, get a sense of how much is it down to one chap on his own or one woman on their own. So I don't know if you want to...
Yeah, I think also you need to take into account the tenure of the individuals and how stable the organisation is, because that will give the strength to the bench. Very much at Newton, we do take a team-based approach. And it's not just the 8 people on real return, it's the 75 people within the organisation. So I think that's very important to try and understand that, and as trustees to meet all of the team members to really get a feel for the talent within the group.
Okay. And Olivia, what's your take on that?
Sure. Team approach is essential, and also ensuring that portfolio managers, senior people have skin in the game is perhaps one of the killer questions that needs to be asked, and that is important. And I think I was reading the other day that there is some kind of correlation between the skin in the game and the long-term performance of fund managers. So I think that is something that trustees and professionals have to look for.
I think coming back to one of your questions, what is the killer question for trustees? And to your point, it's whether the process is actually repeatable. Performance is obviously in the past, but whether the investment process can be repeated.
I mean, we haven't gone into great detail, but coming back to the question is what would we actually look at? You'd look at how, is it a top-up, top-down, bottom-up approach to it? Does Newton or Luxor have a company view on assets and markets, and then that's forced down onto the fund managers? So you're absolutely right. Where is the flexibility around that? And the point that you made is a entirely valid one. Give me some examples of positions that you've sold in order to demonstrate what you're doing, the activity. So there's lots of questions you can follow through on that line as well.
Yeah. Having sat through a number of pitches from different managers, one thing that trustees find very helpful is a chart that sets out how the investment has looked over the last 1, 3 and 5 years. And they're coloured bar charts, I don't know if you've seen it, but to compare different charts in that way is really quite helpful. So it gives a bit of colour, literally, to how, and describes how the managers are actually investing. But I think that liquidity point is quite important, because there's a lot of fear in the market with bearings, or can we get out, should we get out quickly, or are we going to be stuck not being able to sell? And so liquidity is quite important. I love the killer question, because if you actually try and think of a killer question, well, I think there's 5. So it's a sort of multiple stabbing, as it were. But if you think, one thing we haven't come around to is fees.
Yeah.
And I think that there's got to be a lot more transparency on fees. I think how people handle risk, and that's risk in the investment itself, but also spreading the risk over a number of... How are you pooling that sort of risk? Succession planning is really rather big. Use of derivatives. The other thing that I quite like to see is what's the limit on cash in the portfolio? What's the limit on commodities in the portfolio? Are there individual limits, and where do they fall, and how does that all fit in? And those bits of information are quite readily comparable between funds if you're looking at a pitch over a number of different managers. So I think there's at least 5 killer questions.
Giles, what's your take on the DC side?
I think it's very much about looking at the population you are trying to invest for. In theory, you could put together a global equity type arrangement which will produce high growth. And actually, if you've got a very high percentage of default people who don't consider their investments very often and aren't going to move out of that default fund, that actually may be a very good, solid, low-cost solution. If you've got people who are considering it more regularly, who are looking at their funds, who are likely to be concerned about more volatility, then I agree, blending in absolute returns or DGFs or whatever, but you just need to be aware of what you're trying to achieve and how you're trying to achieve it. But I think the most interesting period for sort of absolute returns will be around drawdown that's coming in and everything like that, because then capital preservation will become much more relevant, because you can't accept the volatility within drawdown. So I think looking at income producing absolute return funds will be particularly interesting in the DC world.
We had a hedge fund which the fee level was not going to work post-April 2015, so we've had to sell out that fund completely, but which has had consequences for the fund itself. It's no longer viable, so the fund is closing in its current form, and we are reinvesting that money elsewhere. So I think, yes, fee levels are very important. And again, I come back to DC and communication. All the ones that I'm involved in, members, certainly through the SIP, expect to see what the costs are of being in those funds.
I think that there is a new cycle in the DGF space. Some of the funds have grown a lot, and now new funds are emerging, and hopefully the new funds will benefit from the lessons, or will learn the lessons of the past. And I think one of the lessons is around fees, and I think trustees will see it as a good news to see that fees usually in these products are, how should I say, moderate compared to previous standards.